Okay, so this is chapter 10, and here we're going to talk about capital market integration. So if you remember, in the previous two chapters, what we did is we looked at the goods market integration, we looked at the purchasing power parity in its different flavors, and we said, well, the real exchange rate, which is the deviations from the purchasing power parity, was evidence that those goods markets are not integrated, right? The purchasing power parity, if it held, it was holding because of arbitrage, because you could buy from the low-priced country the good and sell it into the high-priced country, and that arbitrage was supposed to, integration and arbitrage were supposed to make the purchasing power parity hold. But we saw that you have important deviations from the purchasing power parity, which is what the real exchange rate was, and we talked about the different reasons why this could happen. We focused on the non-tradables, we focused on home buyers, we focused on tariffs, and so on and so forth. Now, we're shifting gears here and we're going to look at something very similar but for capital markets integration. So this chapter 10 introduces the concepts and how we can test if capital markets are actually integrated or not. And then in chapter 11, which we're not going to cover, it talks more about capital controls and the reasons why capital markets might not be integrated. But Chapter 11 is more like a special topic that goes a little bit too much into detail about this, so we're going to skip chapter 11 and we're going to continue with chapter 12 after this chapter 10. So this is what we're going to do in this chapter. We're going to talk about the covered interest rate parity here. We're going to introduce the theory first and then the evidence to see if it holds. Then we're going to shift on the uncovered interest rate parity, again looking for testable implications. We're going to see the carry trade and the forward premium puzzle, how both of these show that the uncovered interest rate parity does not actually hold. And then we're going to look at a real interest rate parity to see if we can test capital market integration based on real instead of nominal interest rates. And then at the end, we're going to look at the correlations between savings and investment, the so-called Feldstein-Horioka puzzle that pretty much says that even if you see a high savings and investment correlation, does not necessarily mean that capital markets are segregated. And we're going to cover the criticism for the Feldstein-Horioka puzzle. So this is the quick outline of this chapter. Okay, so again, we looked at chapter 8 and we talked about goods market integration. If markets are integrated, then prices expressed in the same currency should be approximately equal. We looked at this equalization of those prices through the purchasing power parity, and we said that in most cases it does not hold, so that we had only the relative purchasing power parity in the long run we could say that it holds, otherwise in the short run, and the absolute purchasing power parity did not hold, so that you had important things that determined the deviations from purchasing power parity. Now, what we're going to do is we're going to look at the same idea but for capital market integration. In other words, we're going to have free capital mobility here, and in the presence of free capital mobility, if markets are integrated, then we'd like to see if interest rates are going to equalize. So we're going to be basing our discussion on the interest rate parity. And of course, the idea is that if you have free capital mobility, the interest rates in different countries adjusted for, we're going to see how we adjust for the different currencies should approximately be equal. That's the interest rate parity that we've been assuming so far. And then we have a recent increase in globalization, which is caused by the decrease in the information and communication technology costs. We had the decrease in capital controls. We have the integration of the European Union and the creation of the euro, the integration of China in the World Trade Organization. So all of these things help or increase the financial globalization and will probably help financial markets be more integrated. So we'd like to test this and see how we can judge if capital markets are actually integrated. And we're going to base this discussion on the interest rate parity, both the covered, uncovered, and real interest rate parity. We'll see which one we'd like to test the capital market integration with. Okay, so we're going to be focusing on these interest rate differentials. And the idea is that if you have free capital mobility, the return on risk-free assets should be approximately equal. So here risk-free assets are the government bonds markets, right? These are the return on government bonds. So these returns of those risk-free assets, for example, between the US and Germany should be equalized. If they're not, you're going to have arbitrage forces with free capital mobility are going to borrow low, sell high, until the interest rates or the exchange rate are going to equalize, are going to adjust in order to equalize this. So this arbitrage, just like in the goods market, was supposed to eliminate the differences in prices of goods. Here it's going to eliminate, or is supposed to eliminate, the differences in returns for different assets. So if we want to look at the capital market integration, we have to look at interest rate differentials, whether interest rates are higher or lower in one country versus the next, and see if those are the same. Now, it turns out that that's not straightforward, because those interest rates on these returns on those government bonds are paid in different currencies. When the US government borrows, issues bonds and pays return, this is in US dollars, and when the German or the Greek government or any other government borrows, it issues in their own currency, in this case the euro. So if you have an example of a US interest rate paying 7% and Germany paying 3%, it's not necessary for capital to flow to the US. In other words, if you have free capital mobility with different interest rates, people will borrow in Germany, lend in the US, and then make an arbitrage profit. But that's not necessarily the case, because the return on asset is not only related to the interest rate that asset earns, it's also related to the currency. When you're converting from euro to US dollars and vice versa to profit from this, what's going to happen is that you have to see what's going to happen to the currency exchange rate from one period to the next. So you have to somehow adjust for that currency appreciation or depreciation. Even if the US has a higher interest rate versus Germany, if the US currency depreciates in the meantime, that's going to subtract from this return that the US is higher. So we have to adjust for the currency appreciation or depreciation. So let's give an example with US and Germany, just to see how this appreciation or depreciation is going to play a role here. So if you invest $1 in the US at the interest rate of IT, after 1 year you're going to have 1 plus IT. So that's the return that you would get in the US of investing $1 US in the US. Now we'd like to see how much that return is going to be if you invest that same $1 US in Germany, let's say. Now, if you want to invest in Germany, you have to convert that to euros. So we'll have to $1 US to convert it to euros at the exchange rate of epsilon t here, because the epsilon t is defined as the domestic currency divided by foreign currency. So this epsilon t is how many US dollars 1 euro is going to buy. If you want to convert the $1 US into euros, you have to divide it by epsilon t, and then you take this 1 over epsilon t euros, and then you invest in the German interest rate it star, and after 1 year you're going to have this many euros, the 1 over epsilon t euros times the 1 plus it star interest rate. This is going to be the amount of euros that you have. Now, in order to compare to the return to the US, you have to convert that back into US dollars. So you have to take that amount of the euro and then convert back at the exchange rate epsilon t plus 1 that's going to prevail 1 year from now. So once you convert that, multiply the whole 1 plus it star over epsilon t by epsilon t plus 1, that's going to be the return from investing $1 in Germany in US dollars in order to compare to your return in investing in the US dollars in the US. Now, you can convert this at epsilon t plus 1, which is the future spot exchange rate, or you can convert it right now by using the forward market at the price ft. So that epsilon t plus 1 could be exchanged right now. You do on the forward market, you say, look, I would like to exchange 1 year from now at the specific price ft 1 plus I t star over epsilon t euros, so that you don't rely on what's going to happen between now and 1 year from now to the exchange rate, right? You don't want to risk that exchange rate going against you, so you can fix that price. Now, because you can fix that price on the forward market, this is going to be called the covered interest rate parity. In other words, you have hedged your bets. You don't depend on how much the exchange rate is going to change, because you fix the future price at which you're going to sell those euro right now on the forward market, and you have contracted at a price of ft. So the covered interest rate parity holds if the return that you get in the US 1 plus IT is equal to the return that you get in Germany 1 plus IT star adjusted for the currency appreciation or depreciation. So if this holds, So if you have free capital mobility, this should approximately hold, because those two returns are the returns that you're going to get in two countries adjusted for the exchange rate. And if you have any differentials from this, it can be exploited by borrowing into a low return, lending into the high return, and making a profit. So if capital mobility holds, if you have free capital mobility, that current covered interest rate parity should hold. Now let's give an example of how you can actually exploit this. Suppose that the interest rate in the US is 7% and the interest rate in Germany is 3%, and then the current exchange rate is half a US dollar per euro, and then the future on the forward market, that forward rate is going to be 0.51, so that you see that this is supposed to go up in value, which means that the US dollar is supposed to depreciate. Now if you compute the covered interest rate differential based on this, on these data, so you get the return on the US minus the adjusted return in Germany, that's going to be a positive amount. Positive amount means that you have a positive profit possible by borrowing in the low currency, in the low interest rate currency, which is in euro, and investing in the US. So borrowing in Germany, you're going to owe this much after 1 year, and then investing in the US, you're going to have this return, which means that you're going to make a profit of 0.0194 or approximately 2% profit. In other words, this is going to be how much you make per dollar, but this is pretty much 2%. So that if you borrow $1 million, you get 2% out of $1 million, and that's risk-free, right? You don't have any exchange risk because you are not relying on the exchange rate from changing from one period to the next. Now let's see how you can exploit this opportunity. So you can borrow, in this case we said the return in Germany is lower, €1 in Germany. If you borrow €1, you have to repay at a 3% interest rate 1.03 euros 1 year from now. Now that's €1 you convert according to the exchange rate to 0.5 US dollars, and then you invest this 0.5 US dollars in the US, and that's going to earn you the US interest rate times 0.5 US dollars, which comes out to 0.535 US dollars. That's the return that you get in US dollars from investing in the US, the euro that you've borrowed from Germany. Now remember, you have to repay 1.03 euros because that's what you've borrowed. So you convert the US dollars that you have returned into euro. So that's, you need, remember, 1.03 euro. At the forward exchange rate right now, you're not going to need 1.03 times the forward exchange rate, 0.5253 US dollars, in order to repay 1.03 euro at the forward exchange rate. Notice that after you repay that 1.03 euros, the profit that you're going to get from that strategy is going to be the return that you get from investing that euro in the US, which is 0.535, it's this one right here, minus what you use to repay the 1.03 euro that you've borrowed, which is this one, 0.5253, which is a positive amount, and this is per dollar. So this is approximately 1% return per dollar. Now there is no exchange rate risk because you have used the forward market and you have hedged your bets. No matter what happens to the exchange rate between the euro and the US dollar 1 year from now, there is no initial capital involved because you have borrowed the money, which pretty much means that that's a riskless profit. Now those riskless profit, those free lunches should not exist, so that if you have free capital mobility, those return differentials have to equalize to make sure that the covered interest rate parity holds. So that's the idea behind the covered interest rate parity as a test for free capital mobility. Okay, so this is how you would exploit the covered interest rate parity not holding until the exchange rate or the forward price or the interest rates adjust in order to make it hold. Now, do we have evidence of this covered interest rate parity holding? In other words, can we judge the capital mobility based on the data for the covered interest rate parity? Well, we have the US and UK exchange differentials between 1870 and 2003 in picture 10.1. So notice that before the First World War, which is in 1914, that differential came pretty close to zero, so it was less than 1%. Then you have all these big deviations from 1914 until about 1985, and after 1985 until about the beginning of the 2000, it was again very close to zero. So we have evidence that the covered interest rate differential was holding before the First World War, and it was also holding after about 1985, which means that we had free capital mobility, the covered interest rate parity actually holding before the First World War and after 1985, which gives us evidence of substantial capital market integration both before 1914 and after 1985. And notice that what happened between those 2 years is that you had both world wars, you had the Great Depression. So you have all sorts of different things that disrupted the capital flow between countries, and this can be seen in those return differentials deviating from the covered interest rate parity. And then we have the same pattern for US and Germany, US and the UK. So we have evidence of the covered interest rate differential holding before First World War and after 1985. So we can conclude that we had substantial capital market integration in those two periods. And then in between, with all sorts of different political events happening, you had all these kind of disruptions to free capital mobility. Okay, so let's have an alternative measure to see if this covered interest rate parity hold. We're going to measure alternatively. So far we used pretty much different currencies, euro and the US. Now we want to see if the same currency earns the same return in different countries. Let's compare New York and London, and let's see, compare the deposits, the interest rate that deposits earn in New York versus the ones that US dollars earn in London. So we're going to compare these time deposits in New York versus London. These are called the onshore and offshore rates. And when you invest your, let's say, US dollars in a foreign currency, those are called euro currency deposits. So the dollars in London are called euro dollars deposits. So we're going to measure this euro dollar deposits as an offshore rate and then the onshore rate, and see if those two rates are the same. Again, if capital markets are integrated, those two rates should be pretty close. So you have the offshore onshore differential, which is just the difference between the two interest rates. Remember, we don't have any exchange rate here because we have only one currency, this is the US dollars. And free capital mobility is going to imply that those two returns should be the same. If they're not, you can always take advantage of the lower interest rate and the higher interest rate in order to borrow low, sell high, and until those two rates are going to equilibrate each other. The evidence is figure 10.2, which is, this is the differential. Notice that since about 1985 it started to go down. In the 1990s it became less than 1%, approximately zero, and then you have the financial crisis in 2008, and then it was going back to a lower level, but not as low as it used to be, let's say from the 1990s to about 2008. So by the 1990s that differential was zero. So by the 1990s you can say that you had a very good capital market integration. And then you had the global financial crisis. Again, you have all sorts of countries introduce that prudential regulation. The regulation impedes the free capital flow among countries. So you could expect, even after the crisis itself, that differential to remain around 2%, which is higher than what it used to be before that crisis. And you have a very similar pattern in other countries. So pretty much from this evidence, both the on and offshore differentials and what we saw before about the covered interest rate parity, you can conclude that you had this capital market integration before 1914 and after 1985. Again, by the 1990s, this integration became pretty high, and then the disruption of the financial crisis and continuing with a still small differential, but not as small as in the 1990s until 2008. Okay, so this is the evidence, the theory and the evidence for the covered interest rate parity, and the covered interest rate parity is the main tool that we're going to use to judge the integration of capital markets. Now we're going to see the uncovered interest rate parity later on. We're going to see the real interest rate parity and some other things. It's going to turn out that those are not useful in judging if capital markets are integrated. In other words, you can have the uncovered interest rate parity, the real interest rate parity not holding even if capital markets are integrated and you have free capital mobility. So the main tool to judge if capital markets are integrated and if you have free capital mobility is this covered interest rate parity. And again, this is the best evidence that we have here about how much it holds. Starting from the 1870s, the two world wars, the period between 1914 and 1985, and after 1985 until about 2003, and then the on and offshore starting from about 1980, showing this convergence before the financial crisis. Okay, so in the next segment we're going to introduce the uncovered interest rate parity. Again, we're going to see the tests for it. We're going to see the real interest rate parity in order to see which one of these is going to be the most useful one to judge capital markets integration.